makers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, a cooling U.S. labour market and UK inflation dropping more than expected. In just a moment, we'll discuss all of the data headlines with Josie Anderson, European economist at Nomura. But first, a grave violation of international law is how Caracas is describing the U.S. move to blockade sanctioned oil tankers moving in and out of Venezuela. Now, it follows a U.S. military buildup in the region, with the White House accusing Venezuelan President Nicolas Maduro of presiding over narco-trafficking operations. So let's bring in Will Kennedy, Bloomberg's news director for Europe, Middle East and Africa. Will, thank you so much for joining us. I mean, this is really an escalation, a significant escalation. What could happen next?
It is a significant escalation, and it's clear that the Trump wants to put a lot of pressure on Maduro with an aim to frankly speaking, get him out of office. And this is a part of that process. We've seen pressure put on in other ways, the military build-up in the region, the strikes on boats, which the Trump regime accuses of drug trafficking. But this will really put a lot of pressure on the Maduro regime. It's very dependent on the revenue it gets from oil imports for its hard currency earnings to support the regime, and if this really stops those tankers, that oil flowing, it will make life very difficult for the Venezuelan government.
What does Trump want there?
Trump wants, I think, well, yes, he does, and I think he wants a new regime in Venezuela. The thing about the Venezuelan oil industry, was hugely important. The reserves are among the biggest in the world, but over the 25 years so that we've had this socialist regime in Venezuela, we've seen oil production, oil exports progressively decline. At the moment, they're only exporting a little over 500,000 barrels a day, and that's against the context of global demand of more than 100 million barrels a day. So they're not that vital to the oil market today, but there are huge opportunities there if there was a change in regime, and I think Trump sees the opportunity for the U.S. oil industry.
Well, oil is about at $60 a barrel. There are a lot of fears about a glut. There's a lot of hope about some kind of ceasefire in Ukraine. How much uncertainty is Venezuela and in general U.S. foreign policy adding to the price of oil?
Yep, I mean, Trump has shown himself to use sanctions, oil sanctions, as a way of achieving political ends. So you've got these sanctions and this action on Venezuela. You've got sanctions on the Russian oil industry, and that has added some upward pressure, but it's against the background of a much more bearish picture in general. The market appears very oversupplied. There's a huge amount of oil in tankers on the water. We saw Brent trade below 60 yesterday for the first time since May. And there's a bit of a reaction today, but I don't think it changes the broader market narrative, which is pretty bearish right now.
So is there going to be, is there a glut in 2026? We spoke to the TotalEnergies chief executive yesterday, and he really pushed back against that.
He did, and I think his argument would be that demand continues to be strong, demand continues to push to the upside. I mean, he does have quite a lot of oil to sell, but and so there is that countervailing force in that, if the global economy stays relatively robust, demand will rise. We've seen less emphasis on the energy transition. You saw the news about EVs in Europe, which sort of sets the mood. So there is that countervailing trend, but right now there is an oversupply in the market, and people do in the early part of next year. Most people expect prices to trend a little bit lower.
Well, thanks so much, as ever, Will Kennedy, Bloomberg's news director for Europe, Middle East and Africa. One of the busiest people at Bloomberg, I would say. Now, another important headline crossing the Bloomberg terminal on geopolitics. The U.S. is preparing a fresh round of sanctions on Russia's energy sector to increase the pressure on Moscow should President Vladimir Putin reject a peace agreement with Ukraine. That's according to people familiar with the matter. Now, Bloomberg understands that the U.S. is considering options such as targeting vessels in Russia's so-called shadow fleet of tankers used to transport Moscow's oil, as well as traders who facilitate the transactions. Now let's dive a little deeper into the markets after the cooling in the U.S. labor market and UK inflation actually falling to its lowest level in 8 months. We also need to look ahead to decisions from the Bank of England and the ECB, with the Bank of Japan due on Friday. Well, we're joined by Josie Anderson, European economist at Nomura. Josie, thank you for joining us. When you look, first of all, at UK inflation here in the UK, what does that mean for the BOE decision? It seems to be making their life a little bit easier.
Yeah, I think it does. And the surprise slowing of UK inflation this morning, which was fairly broad-based, we think doesn't just add to the chances of a rate cut tomorrow. We actually think tomorrow we could see more people than we previously thought voting for a cut, perhaps even an 8-1 split, or Taylor voting for a 50-bip cut as well. But looking ahead, we could even see, we've seen more aggressive pricing for cuts next year. It could raise the probability of more cuts than we currently think happening next year.
So when you look into next year, are we going to see a bit more stickier inflation? Again, the UK is a little bit more complex because of domestic issues, some of the labour policies put in place, and again, it's a small open economy.
Yeah, exactly. So global factors play such a key role in UK inflation. But aside from any surprises, we do see it slowing back towards target next year. And of course, that's what we think will allow the Bank of England to cut the policy rate into what it sees as broadly neutral territory, which is quite a wide range, admittedly, of 2 to 4%.
What does it mean in terms of, if you look at the differential between the US and the UK, but also the Bank of Japan, is there a danger that, the Bank of England governor needs to look at this? And actually, he has been the deciding vote. How much does he think about external factors?
Yeah, of course. And, the US cutting rates more next year. We see 2 more rate cuts next year. Of course, policy rate differentials can play key roles in FX moves and therefore inflation, in particular through import prices. We currently don't see those 2 cuts we expect in the US. Adding to our expectations of rate cuts next year, we see 1 more rate cut after tomorrow happening in April. But of course, if the US economy surprises us to the downside next year, if GDP growth is slower and there are more rate cuts in the US, then we might be looking at how that will impact the UK.
And Josie, is this regardless of who's the next Fed chair?
Well, we do see the possibility that the next Fed chair will be more dovish, will play into the probability of rate cuts next year. We don't expect any more rate cuts under Powell being chair. And we also do actually expect factors like AI to raise GDP growth in the US next year. And we still expect cuts despite that, because we do expect the next Fed chair to play a role in adding to reasoning for them.
Josie, what's your take on ECB? So we had this fantastic interview with Isabel Schnabel that's kind of changed the way that the market perceives the ECB interest rate dynamic. Do you think the next move is a hike, and how soon could we get it?
In terms of the next move, we think that will be driven by a shock, not fundamentals, because, at 2%, the policy rate in the euro area is neutral, and the ECB has been clear that it is in a good place. And so, we think there are actually many downside risks to inflation next year. We don't expect a cut. We expect it to remain at 2%. But things like slowing wage growth, the recent appreciation of the euro, are factors that could add to slowing inflation and indeed base effects from energy will, we think, contribute to slower inflation, particularly at the start of next year. We think they'll look through that, but it will still play a role in slowing inflation.
What's the biggest problem Europe is facing right now? I know it's competitiveness is not where it should be. Productivity. There's a lot of concern about, for example, politics in Germany and France, even with the lack of a budget. Will that overshadow some of the economic prowess of the region next year?
Yeah, we're really excited by German fiscal spending. We think this is a key theme looking into next year, and this will boost GDP growth. But obviously, we've got to balance that with fiscal tightening in places like France and Spain. We think, it will contribute to growth. We see growth picking up to 0.4% quarter on quarter by the end of next year. And we do think also, increased defence spending will feed into that, as well as the gradual increase in growth of consumer spending, particularly perhaps as savings rates ease, because that's a key question about in the UK as well, whether they will ease. And so we are quite positive on growth, but there are these risk factors, including perhaps slower spending from the government, the German government. If that, comes in surprisingly slowly, then that could push growth further into the future.
And Josie, when it comes to the Bank of Japan, they're just going the other way. How difficult is it to go against the grain?
Yeah, well, Japan, it beats to its own drum. We do think that this week they will definitely hike. But then actually we see a pause for all of next year and then 2 more hikes in 2027. And so we do actually see inflation slowing next year, and that's why we don't think that there'll be those hikes for a year. They'll take a pause. But this week they'll hike.
Thank you so much for joining us. Josie Anderson, their European economist at Nomura. Now, Ken Griffin, the Citadel founder and chief executive, says Republican policies on tariffs and immigration are driving inflation. In a conversation with Bloomberg in Paris, he said the push for deregulation will ultimately stem those pressures in the long run.
The big picture is the American consumer is tired of the persistent and sticky inflation. They feel like they can't get ahead in a world where their savings and their wages are constantly deprecated by the impact of inflation.
Why aren't Republicans speaking to that? Is it an issue of not having the policies, of not communicating the policies correctly?
So I think it's actually fairly complicated. I think that the Republicans struggle with the reality that many of their policies, which they ran on, for example, ending illegal immigration into the United States, are actually pro-inflationary, right? When you end illegal immigration, you reduce the size of the available workforce, that's pro-inflation. And so the Republicans are grappling with tariffs, another case study. When you impose a tariff, it's a regressive tax on consumers. It's pro-inflation. So some of the very policies that the Republicans have put forth and have been successful in implementing are actually the very policies that tend to be pro-inflation. Some of the other policies, for example, deregulation, are just going to take longer to play out. And ultimately, deregulation, which should unleash productivity gains, will create a reduction in inflation, a very healthy reduction. But we need to get to that point in time.
Ken Griffin there, the Citadel founder and chief executive, speaking to our Danny Berger. Now, coming up, as EU and West Balkan leaders meet in Brussels today, we'll be speaking with the president of the Republic of Kosovo. That's next, with the country in political deadlock. This is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, Kosovo will return to the polls for a second snap vote this year, as months of political deadlock stall Kosovo's ambitions to join the EU and tensions with Serbia continue to simmer. EU and West Balkan leaders meet in Brussels today. Let's go to Bloomberg's chief Europe correspondent, Oliver Crook, who's with the country's president.
That's right, Francine. Thank you so much. We're very pleased to be joined in the studio by the president of Kosovo, President Osmani. Thank you so much for taking the time and speaking to us on the sidelines of the EU Western Balkans Summit. I'd like to start, if we might, on the situation in Ukraine. The Trump administration, if it is to be believed, we could be at the beginning of an endgame of that war. One of the contributions that's been floated from the EU side is potentially fast-tracking Ukraine to EU membership, they say as early as 2027. As a country, like so many of the other Western Balkans, who have been waiting to get into the EU for a very long time, how do you view that?
We fully support Ukraine's membership in the European Union. Obviously, we wish this to be a merit-based process for everyone, not just for Ukraine and for ourselves, but everyone, every aspiring member. So we do hope that, of course, criteria will be fulfilled, while at the same time we need to look at this from a strategic and security imperative as well. I think a Ukraine in the European Union will make the entire continent safer, the same way a Kosovo and a Western Balkans, based on merit within the European Union, will contribute to this dream that starts with the founders and continues to date. That a Europe whole, free and at peace is something that we all strive for. So I do hope that, of course, Ukraine moves forward, but at the same time that the European Union member states will not forget about the rest of us that have been striving, have been working, have been 100% aligning with the European Union on common foreign and security policy, as well as really standing with the values of the European Union and what the Union stands for, even when it's hard, even when it has a high political cost, and even if that means also creating other adversaries, having Russia, China, and countries like Iran with crazy ideologies trying to push forward their influence, and us really rejecting it because we believe in the European Union, and also reforming internally should be something that is not taken for granted, but actually used to move us forward much faster.
And I'd like to get your perspective as we enter now almost 4 years of war in Ukraine, and how that has shifted kind of the politics of the Balkans, how it's shifted the power dynamic within the Balkans, and what the assessment has been for sort of domestically for Kosovo, but more broadly for the region.
Well, initially after the Russian invasion of Ukraine, what we had hoped was that many would have learned the lesson that appeasing dictators, appeasing crazy hegemonic leaders like Putin is never the answer. Quite the opposite. The more people like him are appeased, the less there is a chance for peace, and the more they would be kind of incited to use violence. At the beginning, that was the feeling, but then what we see is that in our region, the European Union and many countries within the EU, not all, of course, continue to appease Vučić, who is a mini Putin in our region. And this appeasement has led him to use more violence against neighbors, looking at neighbors as temporary states, becoming more and more aggressive, while at the same time he gets the EU money and does not align with the European Union, whether on sanctions against Russia or sanctions against Iran or other fundamental values and decisions of the European Union. This has made the region, I would say, less safe, less stable, and less peaceful. So we do hope that right now, while of course we see that the support for Ukraine is continuing by most European Union member states, that at the same time the Western Balkans will not be forgotten, that those countries that are fully aligned can move ahead. But at the same time, if there is one country, in this case particularly Serbia, that is a continuous source of instability, that the EU will be more firm and more decisive in dealing with that.
And I'd like to get your perspective as well on Donald Trump, the other sort of large geopolitical event of the moment, and its influence on the Balkans and potentially on relations with Serbia. Do you think that Donald Trump, will he be do you welcome his attention on the sort of tensions that exist between Kosovo and Serbia? Do you think that he could be a helpful factor there in ratcheting them down and getting to a breakthrough in normalization?
President Trump has already been a helpful factor. Since the beginning of the mandate, his administration has shown a lot of attention to the Western Balkans, and he has personally been involved, as he stated multiple times publicly, in supporting peace, not just between Kosovo and Serbia, but supporting peace in the wider region. He personally got involved, including members of his administration, in stopping an escalation that happened recently, and we have the attention of his entire administration to make sure that we sustain peace. And of course, through the support of the United States, we have U.S. forces in our region, more particularly in Kosovo. And that is the biggest deterrent, I would say, and the biggest prevention to an escalation in the region. Kosovo has been a full contributor to peace and stability in the region, but obviously we have a crazy neighbor that needs to be stopped now and then. And the role of President Trump, the peace through strength formula, it's exactly what works in the Western Balkans.
And how concerned are you about the change potentially in the U.S. troop posture? You say that it's one of the really sort of critical things. We saw the national security strategy that came out a couple of weeks ago, where very emphatically the United States wants to take its attention and critically its troops away from Europe. How concerning is that to you?
Look, Kosovo is an American success story. It's a flawless American foreign policy success story. Of course, we've been blessed to have a bipartisan support. It was during a Republican government that we declared independence. It was during Trump 1 that we've achieved a lot of successes, and now we truly believe that during Trump 2, there can be a breakthrough on many of the issues that were left aside when it comes to the Western Balkans. The American posture in this region, while it's a small one, it's about 500, 600 troops, the impact is enormous. Just imagine, in a region that peace never existed for centuries, actually for millennia, it is the very first time in the history of the existence of that region that there is peace, that children can go to bed without the sounds of firearms and bombs and grenades. And that is an amazing contribution of the United States of America. So I strongly believe that there would be no change to that, because the Western Balkans as a region of Europe has always been very important to President Trump and will contribute to this peace continuing and stability growing.
And on that constructive note, what to you are the next steps for normalization normalization with Serbia? We see tensions are sort of escalating. What for you is the main impediment right now?
The main impediment is the leader of Serbia, who used to serve as Milosevic's propaganda minister during the wars in former Yugoslavia. His mindset is one that wants to take us back. The rest of us in the Western Balkans, we want to move ahead. We want to move ahead with Euro-Atlantic integration. We want economic development. We want cooperation with one another. We want to make sure that our past does not become our children's future. We want them to live in peace. We want them to never know war, and we want to become successful members of the European Union and NATO and work closely with the United States of America in projects that will make both of our nations more prosperous. So that is the impediment, obviously, with the leadership of Serbia, but we truly hope that they will get there too, and the sooner, obviously, better for the people of Serbia too, so that the entire region can move ahead with integration.
And I'd like to talk about some of the domestic politics within Kosovo. At the moment, we have a great political fragmentation within Kosovo, inability to form a government. You have an election just a few days away, just under 2 weeks away. Do you expect that election will bring something definitive, that it will break through the deadlock? And if not, do you expect another election next year?
Well, what happened in the past couple of months was actually democracy playing its work and its role. Obviously, in our constitution, if no coalition is formed, we have to go to elections again, and that's exactly what's happening right now. But from the language that is used by the leaders of the political party, I already see a more constructive role from each and every one of them, no red lines to work with one another. So I do hope that we will have a government very, very soon. Once elections are formed, we expect a speedy process of confirming the results of the elections, the formation of the parliament now with some of the procedures already in place and clarified by the Constitutional Court. I'm very, very hopeful. Obviously, that is going to be in the hands of the political parties, but we do need institutions so that we can also move ahead with huge projects with the European Union and the United States of America.
And just in the last 45 seconds that we have here, your mandate ends in April. Would you put yourself forward to be president once again?
I will have a much clearer answer to that once we have a parliament, because of course it will depend clearly on the composition of the parliament. But I do hope that Kosovo, and I do hope that the political parties will agree that Kosovo needs continuity, especially in foreign policy, which is an extremely important part of moving Kosovo forward.
Would you like to be president again, though, independent of the parliament?
I'll decide what the people of Kosovo want to, and I will move ahead with based on their will, as it always has been.
Well, Vjosa Osmani, thank you so much for your time there. That the president of Kosovo here speaking on the sidelines of the Western Balkan Summit in the EU.
Ollie, thank you. Our Chief Europe correspondent, Oliver Crook, with the President. Coming up, more of our exclusive interview with Patrick Pouyanné, the TotalEnergies Chief Executive, who says rising demand for oil will underpin prices. That's next, and this is Bloomberg. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. President Trump orders a naval blockade of sanctioned oil tankers entering and leaving Venezuela. That increases pressure on Caracas as the U.S. expands its military presence in the region. Bloomberg understands that the U.S. is preparing a fresh round of sanctions on the Russian energy sector should President Putin reject a peace agreement with Ukraine. Plus, OpenAI is in talks to raise at least $10 billion from Amazon and use its chips in a deal that could value the company north of $500 billion. Now, private sector activity in the euro area grew less than anticipated in December as Germany's industrial sector unexpectedly deteriorated. Data from IFO this hour also showing that business confidence is dipping in the region's largest economy. Well, joining us now is Konstantin Veit, a European rates portfolio manager at Pimco. Konstantin, thank you so much for joining us. Look, the dynamics in the European Union have always been complicated, but do you see a 2, 3 or 4-speed Europe at the moment?
The institutional configuration is obviously peculiar in Europe, and it's difficult to come to a consensus in general. And typically, it takes a crisis to make big progress when it comes to the setup. So it's always difficult to agree amongst the large number of countries. And some jurisdictions are certainly more willing to move forward than others. So typically it's a bit slow, but I think it's not different today than at any time it has been over the last 10 or 20 years.
Do you think the ECB is done? Is the next move likely to be a hike rather than a cut?
I think the ECB is done, but the verdict is out on the direction of travel. So we will be watching. So if you look at inflation, it's broadly a target. Growth is around trend. 2% is probably the midpoint of a neutral range. So there's no reason for the ECB to do anything. And where it goes from here depends on a bunch of things, like, for example, what fiscal is doing, where wages go, where the wages develop in line with the staff projections. We get new projections tomorrow. So that will be interesting to see. But I don't know whether it will be a cut or a hike in terms of next move.
But with Isabel Schnabel actually saying that it is a hike, is it messaging the markets, or is it because, again, is it just because the markets are waiting for something, whereas actually the ECB is in a pretty good place?
Schnabel is obviously very influential, but she's also a well-known hawk, and she's focused more on the medium-term upside risks to inflation, and she is not, overly concerned about small deviations from target over the near term. So the ECB projects an undershoot of inflation next year, and the question is to what extent this would warrant a policy response, and she just thinks that the ECB is in a position to look through. And Philip Lane actually gave a speech on this and said, if it's a supply shock driven by, for example, energy base effects, there's no reason to be overly worried.
Where do you find value in Europe?
I think it's interesting that not too long ago we have talked about Japanification of the euro area, and we have been in negative policy rates, and we thought we would never get out of there. So Europe was not a particularly attractive place to invest in, which is very different now. So Europe is back, rates are reasonable, and the good news for investors, I think, these days is you don't have to take a lot of risk to earn a decent return on your investment. It was very different 10 years ago, where you had to reach out the interest rate spectrum or the credit spectrum. So you can keep it fairly high quality these days, short in terms of interest rate risks and up in quality in terms of credit risk, for example.
But do you do is it Italians, or France still doesn't have a real budget? I don't know whether there's an expectation there that something advances pretty quickly. So do you play country against each other?
Yes, there's a lot of relative value you can play. I think it's interesting if you look at France, and France is not different to other jurisdictions in a sense that you have seen repricing on the back of changes in fundamentals across countries. You have seen it in the US, you have seen it in the UK, in Japan. Germany in March, for example, we had the 10-year in Germany move 50 basis points on the debt break developments we've seen back then. And now France has repriced 20 basis points, say, on the back of worsening fundamentals, which strikes us as reasonable. And, if you look at the budget plans from here, Italy seems to get their act together. France is a bit more questionable. But also Germany, if they don't improve the productive capacity of the economy, you could in 10 years end up with a worse trajectory than Spain, for example, in Germany. So it's quite interesting indeed in terms of relative value across jurisdictions.
But Konstantin, how do you see Germany right now? Because there is because of the defense spending, there's a lot of hope pinned on that also having a pretty big impact, I think, from 2027 on GDP. But again, politically, the chancellor seems weakened.
Yeah, we do agree with a cyclical boost. So we see stronger growth over the near term, but we do not see the reforms that would make us hopeful in terms of raising growth potential in Germany, which is important for that trajectory over the medium term. So yes, near term that will be helpful. But over the medium and longer term, we don't think it raises growth potential, and as such, we're not overly optimistic in terms of fiscal dynamics when it comes to Germany as well.
Konstantin, what kind of duration do you like on European bonds?
We like the intermediate part of the curve, so anything between 5 and 10 year is a good place to be, while we are cautious on the longer end. We have been for a long time. The yield curves have re-steepened quite a bit, so you want to take a little bit less risk there than you have done before, but we have the Dutch pension transition, for example, coming up, which is a big topic in the market. So overall, there might be still some room for yield curves to steepen on the back of this.
I was going to ask you actually about the Dutch pension transition, which seems to be one of the most talked about topics in European rates. So how do you see that impact playing out in the markets?
Yeah, it's interesting. So the first point I would make is curves have adjusted already. So there have been a big re-steepening, big normalizing of yield curves around the globe. If you look at where curves are right now, they are not too far away from pre-pandemic averages. So the bulk of the adjustment should certainly be behind us. The second point is also, that's obviously a topic that has been much talked about and is well flagged. So you would expect a lot of it to be in the price. And also remember when we talked about QE, for example, it was always an announcement effect you had. And then when the first bond has actually been bought, you saw the reverse effects actually kicking in. So it's unknown what the flows will be. A lot of pre-positioning has happened already in the markets. So I think what is clear is that we will see a lot more volatility in the long end next year. And I think it's prudent to have a modest steepener exposure, and then, you can add on volatility on the back of the Dutch developments.
Konstantin, so good to speak to you. Thank you so much. On a big week, actually, for everyone, especially if you're in rates, European rates. Konstantin Veit, European rates portfolio manager for Pimco. Now, the chief executive of TotalEnergies says he expects rising demand for oil despite the recent slump in prices. Now, I spoke with Patrick Pouyanné in an exclusive interview in Paris.
I trust also OPEC countries to manage the situation. You've seen them beginning to slow down. They are relinquish oil in the market. If the price is too low, you have a sort of natural counterbalance in the US shale oil, because then the US shale oil producer begin to slow down themselves. So at the end of the day, what I'm sure in economy, demand equals supply. So then the rest is going to inventories and the price will adapt. But the world is not linear. Since I'm CEO, I've seen it going down from 100 to 17, 27, 80. We have, last 3 years, it was almost at $80, $70. So it was very good, I know, but it will go down and then it will rebound. It will rebound because fundamentally, because of the energy transition, I think we don't invest enough in this oil business. And so if they slow down, then you will see price will go up again.
So you're the biggest exporters, of course, of US LNG to Europe. Do you worry about prices there, that they put extra pressure?
It's very important what you just said.
Yeah.
Because I read recently an editorial in the Wall Street Journal which was accusing us not to be good US citizens. We are the number one exporter of US energy to Europe. We are fully committed to US energy. We are investing $20 billion in new plants in US energy. We have this year sanctioned an additional train in next decade in Rio Grande. We are the largest one, number one.
When sanctions are lifted, if sanctions are lifted, are you ready back to do business, or are there other considerations?
We will obey, for sure, to all the European regulations. So Europe has recently decided that they want to stop imports of LNG from Russia. We will stop import of LNG from Russia. There is no doubt. Yeah. Today we have continued. It's well known. We are importing LNG from Yamal because it was part of the security of supply scheme. I said myself to the European leaders, from 27 there will be enough coming from the US. So you can replace the Russian energy without having an impact on the market. 26 is in between. I don't know. Today we see a little lower, but honestly $10 is quite a good high price, still a high price. So I would say 26, no, I think the gas price will remain, I would say, comfortable. 27, I think will go down.
When sanctions are lifted on Russian gas and oil, what will you do?
We'll see. I'm not sure they will be lifted quickly. We'll see. As this scenario, we'll see what we will do. It depends. For sure, investing a lot in Russia, not, to be clear. We have some lessons. We were quite a big investor in Russia, almost $15 billion of investments. We draw some lessons. We have made a big write-off of 4 assets there. So, the world is big. So today we have shifted from Russia to the US. This will be maintained. Then we will observe. It will take time because it's a matter of trust. And, in this business, in energy, you invest for 10, 15 years. So building the trust is just fundamental. It's not a matter of geopolitics. For me, the matter will the board of TotalEnergies trust to put a lot of money in Russia? Today, it will take time. We'll need to be sure that if there is a peace, this peace is sustainable, which, by the way, I hope as well for the whole continent. So we are, from this perspective, a company like TotalEnergies is behaving as a society. We have to draw lessons. So we'll see what we will do, but honestly, we'll not rush immediately.
There are a number of Lukoil assets that will be put on the market.
It's not for me. I have enough projects.
There's nothing that you're willing to buy or willing to
in fact, we are partnered with Lukoil in one refinery in the Netherlands.
Yeah.
So we have found a solution with them.
You can increase that. Are you looking
No,
to
but
increase
they prefer to keep their shares. What we have decided is that TotalEnergies will run the refineries as if it's a 100% assets for TotalEnergies. We'll take all the cost, all the revenues, so I'm fine. I'm an interim owner, 100% of that refinery, which is quite profitable. And when Lukoil will be out of sanction, they will come back. Okay, they prefer to keep that scheme. We'll see if they sell their whole portfolio. We'll see who will be the buyer. We have a preemption right, so we'll see what we'll decide.
The TotalEnergies CEO there speaking to me in Paris. Now, coming up, a shake-up in the battle for Warner Brothers after Jared Kushner's Affinity Partners pulls out of Paramount's takeover bid. More on that story next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, Warner Brothers is understood to be planning to reject Paramount's hostile takeover bid as a major backer walks away from the deal. Affinity Partners, Jared Kushner's private equity firm, is exiting from the takeover battle. For the latest, let's bring in Manuel Baigorri, our deals reporter. Manuel, why is Kushner's Affinity Partners walking away?
I see walking away, right, Francine, from one of the most exciting takeover battles that we are seeing, which is going to transform potentially the entertainment industry in the U.S. and even more so globally, perhaps. There are reasons. The deal became very political, highly controversial over the last couple of weeks as the whole situation unfolded. The agreed deal with Netflix, and then how Paramount came with a hostile bid. Obviously, Affinity was one of the backers. Even if the ticket size, we understand it wasn't that big, it was around $200 million, but still very significant given Jared Kushner is behind it, and also it's the deal per se with Paramount is on the verge of collapsing, perhaps, or at least being rejected by Warner Brothers. That's something that we may see as soon as today.
Where does this leave the takeover battle now?
Yeah, the next steps, Francine, remain unseen. It's most likely we will see Warner Brothers urging the shareholders to reject Paramount's hostile bid. That is the most imminent next step, I would say. But then what's interesting to see will be what Paramount's next moves will be, either walking away, either sweetening the bid, tweaking the financial terms or the financing package, which was, by the way, seen, according to our sources, as one of the main concerns by Warner Brothers board to urge the shareholders to reject the bid by Paramount. So remains to be seen, but I think we're going to see next steps fairly imminently.
All right, Manuel, thank you. Manuel Baigorri, Bloomberg Deals reporter. Now, the Trump administration is threatening to retaliate against the EU over efforts to tax American tech companies. The Office of the U.S. Trade Representative said in a social media post it would use every tool at its disposal to counter EU measures. The department singled out prominent European companies, including Accenture, Siemens, and Spotify, as possible targets. Well, OpenAI is also in an initial discussion to raise at least $10 billion from Amazon. According to Bloomberg sources, the deal under discussion could value OpenAI north of $500 billion and see it adopt Amazon's Trainium chip. Now, for more, we're joined by Peter Elstrom, our executive editor for global technology. I know you've been busy, Peter. I feel like 2026, you're going to be even more busy given all of the deals. Now, this is another mega deal involving OpenAI. What do we know about it?
Yeah, there are a lot of deals going on in AI right now, and OpenAI really is at the heart of so many of them. So OpenAI has been, Sam Altman and OpenAI have been diversifying their suppliers in a number of key areas. In the chip space in particular, everybody is pretty dependent on NVIDIA. Of course, NVIDIA now the most valuable company in the world. Partly that's because everybody everybody has to buy their chips to be able to train these AI models and mostly to run them so far. That's given them incredible margins, huge profits and revenue growth. So in this case, we're seeing Altman and OpenAI trying to diversify on the chips front, where they've looked at AMD, one of the competitors to NVIDIA in the past, and now they're talking with Amazon about using Amazon's chips within their operations too. That would probably bring their costs down a fair bit, and it makes it more competitive for NVIDIA to be able to bid and get its chips into the OpenAI data centers.
But so, what does this mean for Amazon's AI chip ambitions? Because this is something that they've also highlighted.
They've been trying to push this very hard. Amazon, of course, is the leader in cloud computing services, the traditional variations that we saw before AI services. Now you're seeing a lot of competition in AI cloud services in particular, and Amazon is a step behind. They're trying to use their chips, the Trainium chips, to be able to catch up a bit. They think that that's a valuable offer for a lot of the AI companies out there, and they think that this would be, a significant step. Being able to get OpenAI to be able to buy these chips would be a big step forward for them.
In China, another homegrown chip company having a hugely successful IPO. What do we know about MetaX?
Yeah, not to be confused with Meta, the company in California. This is MetaX. It's a chip company that just went public in China. And you're seeing some incredible stories within the Chinese chip space, speaking of competition in AI chips. So MetaX went public. Its shares went up almost 700%. Its market cap is now $47 billion. It's a big company. It's significant. And most of us have never heard of it before. This comes just shortly after another company, More Threads, went public and also reached a valuation of about that level. So I think it shows the intense retail investor interest in these kinds of chip companies within China, because they know that most NVIDIA chips cannot be sold into China at this point. There's a big opportunity for local players to be able to supply the local market and make some big revenue from it. The multiples on these stocks, though, are kind of out of this world, much higher than NVIDIA's.
Peter, it was almost like a year ago that we heard about DeepSeek, and people in the know really knew about it, but some of the common mortals hadn't really heard about it. What do we know so far about where China is with chips and AI?
Well, they're making progress. They're still very far behind, I'd say, on both of those fronts, particularly on chips. They have a long ways to catch up to NVIDIA. You've seen CEO Jensen Huang make the case that he wants to be able to sell more chips into China. He got the blessing to sell these H200 chips, but there's still a market there, and they're still quite a bit behind. On the AI services front, it's quite a bit different. DeepSeek, Alibaba, the other leaders within the China market, are really taking the open source route. They're looking not so much at building these enormous data centers and trying to make a lot of money from those services. They want to do open source. They want to go lower cost route to be able to get AI integrated into business operations much more quickly. That, of course, is with the support and the blessing of the Beijing government.
But, Peter, when you look at how they're trying to actually spur domestic demand for chips, is this going to be the big story for China in 2026, that this will be a success?
They're making progress, and this is a big policy debate in Washington right now, whether the Chinese domestic players, really led by Huawei Technologies, to be clear. Huawei is really the leader. There's a smaller company, Cameracon, that is also competitive within that space, but they're going to be the leading providers. They need to have their chips manufactured by SMIC, which is kind of the TSMC of China. They're quite a bit behind TSMC, unfortunately, for those companies. So we'll see whether they're able to make progress. The argument from Jensen Huang and David Sachs in the White House is they're going to be forced to catch up on the domestic front if we don't supply them some of these chips, and that would taper their interest in buying domestic chips.
And Peter, thanks so much, as always, for joining us. Peter Elstrom, there, our executive editor for Global Technology. Now, Californian auto regulators are poised to suspend sales of Tesla vehicles for 30 days if it doesn't change its marketing practices that allegedly misled consumers. The California Department of Motor Vehicles accused Tesla of exaggerating the capabilities of its autopilot and full self-driving software. The agency said the suspension will not take effect for 90 days to give the company time to appeal or come into compliance. And UK inflation slipped to its lowest level in 8 months in the year to November, a bigger than expected drop. Let's bring in Ven Ram, cross-asset strategist for Bloomberg Markets Live. Ven, thank you, as always, for joining us. Does this data from the UK actually solidify market positioning for a rate cut tomorrow by the BOE?
Morning, Francine. Pleasure to be talking to you. I think it's absolutely nailed on a rate cut tomorrow because it has indeed solidified market pricing. The markets were thinking about 90% chance of a rate cut before today's data, and today's data has meant that they're all but pricing in a full rate cut from the BOE. What will be interesting from the BOE, assuming we do get a cut, it's not a given. If we do get a cut, I think the margin of vote will be of crucial significance to the markets. And if last month we got a 5:4 vote against a rate cut, this time we may get a 5:4 vote for a rate cut, or 6-3, or even a 7-2. A 7-2 would obviously be extremely bullish for gilts because that will cause the markets to front load some of the rate cuts in the that are remaining in the cycle, and also to probably factor in a lower terminal rate, even though that lower terminal rate may not kind of morph into reality later on. I think that the terminal rate is still around 350, so the markets should be gearing up for that.
Yeah. Meanwhile, we've seen a cooling of the U.S. labor market. Where then does this leave the Fed looking into 2026?
I think that the markets are pricing in two rate cuts and a bit more. They're not fully certain about a third rate cut, but I think considering what we are going to get in terms of a Fed chair who is going to be dovish by the nature of his job description, at least by what White House wants, I think that that is going to be written into his job description. And that means that we should be prepared for more rate cuts, even though core inflation is sticky around 3%. I think that the market should be wise to kind of factor in more rate cuts rather than fewer rate cuts.
Then what else are you looking to until the end of the year? I know it felt like last week was certain who the next Fed chair was, and now there's a number of interviews going on with the president. And so I don't know whether that means that it's just a way of President Trump to keeping it in the limelight, or whether we could see a surprise, new Fed chair.
Well, I think that I think that we are likely to get one of the Kevins as the Fed chair. I think the interviews notwithstanding with Christopher Waller, I think that's a bit of a red herring. I think that the markets are should probably bet on, at least I would bet on Hassett becoming the next Fed chair. I think that what is even more interesting from the Asian perspective going into 2026 will be the Bank of Japan, Francine. I think that they are expected to raise rates on Friday, but of crucial significance will be the guidance. I mean, the BOE is the BOJ has been kind of dragging its feet over further rate hikes and further tightening, but given how far behind they are on the fight against inflation, I think that if they are emboldened enough to suggest that they are going to go at a faster pace, I think that will be hawkish for the markets and cause JGBs to sell off.
Ven, thank you so much. As always, Ven Ramder, across asset strategist for Bloomberg Markets Live. Now, this is a picture across the board. Look, oil definitely left, right, and center. Oil advancing after President Trump ramped up pressure on Venezuela. We're also looking at gold actually rising, pushing it close to the record set back in October. We did have that jobs data in the U.S. that did little to strengthen the case for further Fed interest rate cuts. And then a couple of the other things we're watching out for across the board is, of course, sterling, after we saw that inflation data in the UK, 1.3329. Up next, a Bloomberg Brief, and this is Bloomberg.